In this video, I'm going to tell you about 4 major changes to credit reports and credit scores that you must know about in 2025.
All 3 credit bureaus, Experian, Equifax, and TransUnion,
your credit score can drop overnight and you won't even see it coming.
The rule would have wiped out $49 billion of medical debt on credit reports. But last week, the Trump administration paused the new rule.
Hospitals are tending to turn over bills to collections sooner.
And one of these changes also include victims of scams. You will be forced to pay taxes on it even if it was stolen money.
I'm looking at possibly $60,000 on top of my $280,000 that's gone.
All right, this is a lot of information that I want to cover in a short period of time. Let's get right into it. The Trump administration is making policy changes that will affect your credit scores and reports. Some of those changes are going to affect you directly, and some of those changes are going to affect you indirectly. Let's go ahead and break down these 4 major changes, and I decided to add a bonus at the end of this video. Change number 1 is going to be dismantling the Consumer Financial Protection Bureau, also known as the CFPB. Now, for those that don't know, the Consumer Financial Protection Bureau was made to oversee financial institutions and protect consumers from unfair practices. Recently, President Trump and Elon Musk have pretty much done everything that they can to dismantle the bureau. Even major news outlets like The Guardian is saying that former officials say that Americans are more likely to be ripped off and scammed as CFPB is targeted by Musk. Now, a lot of people don't even know this, but the Consumer Financial Protection Bureau has actually returned more than $21 billion to consumers since 2011. Now, some of that $21 billion came from creditrepair.com and Lexington Law Checks, as they had to do a settlement for $1.8 billion to civil penalty funds. The short version is, if there is no Consumer Financial Protection Bureau to look out for consumers, then who's going to be looking out for us? Let me know what you think in the comment section below. Now let's go to number 2 on the list, halting the removal of medical debt from credit reports. So it doesn't matter who you voted for. If you have medical debt, you will be affected.
Pay now, or it may end up on your credit report.
That is a different message than what was going to happen next month when the credit bureaus were supposed to remove all medical debt from their reports. And tonight, Harry's trying to clear things up.
Real quick, be sure to download our free ebook today. All you got to do is scan this QR code right here or click the link in the description below. Now back to the video.
Let's start with a bill that I received that was past due. I owed $29 and I paid, but I didn't expect to see a warning for non-payment potentially impacting my credit. If it's under $500, it won't, but that didn't stop the message.
Medical bills fall into the category of debts we can't control. But until a few years ago, unpaid medical debt and collections hit your credit report like a bulldozer. That's why the federal government's Consumer Financial Protection Bureau finalized a rule in January prohibiting creditors from using medical debt to judge your credit worthiness. The rule, effective March 1st, would have wiped out $49 billion of medical debt on credit reports. But last week, the Trump administration paused the new rule for 60 days. It is all under review. But here's what you need to know. All 3 credit bureaus, Experian, Equifax, and TransUnion, have already agreed not to report any medical debt under $500. If it's over $500, you have a year to pay it off before it goes on your report. As we told you last year, there is a downside, though. Cindy Gatton, the medical bill negotiator, explains.
One of the things that I'm seeing in the Atlanta market is that hospitals are tending to turn over bills to collections sooner, like typically 90 days after the first bill has gone out. That's why it's so important that if you get a bill, that you contact the hospital to try to find out, is the bill accurate? Where is it coming from? Has insurance paid what it's going to pay? So that it stays in that queue as long as possible.
So if you have medical bills that are over $500, Ask the provider for the maximum interest-free payment plan that they offer, but don't blow off the smaller bills.
Now, even Time magazine said that although the rule keeping medical debt off of credit reports was finalized on January 7th, it may be on the chopping block as Elon Musk's Department of Government Efficiency, also known as DOGE, turns its sights to the CFPB. The next major change is number 3. A proposed cap on credit card interest rates to 10%. Now, believe it or not, this is actually something that Republicans and Democrats actually agreed on, okay? And that was, of course, that Trump suggested that capping annual credit card interest rates at 10%, but critics fear that there's going to be some type of price control. Now, this is something he mentioned back in 2024, but it is something that a lot of people want to see. Now, the Washington Post said that government-imposed price controls on credit card interest rates would harm all cardholders, especially the lowest income Americans, who these measures would be intended to help.
A new bipartisan bill is aimed at giving consumers a break when it comes to credit card interest rates, capping them at 10%. Fox Business reporter Jeff Flock has the story.
If you're headed out to the mall with your credit card, you might be cheered to hear that Republicans and Democrats have apparently found common ground on the subject of credit card interest rates. Senators Bernie Sanders and Josh Hawley co-sponsoring a bill that would cap credit card interest at 10%. Senator Sanders saying America is now being ripped off by credit card companies with interest rates so high that they amount to loan sharking and extortion. The conservative Josh Hawley from Missouri saying it's not just wrong to raise interest rates, but it's exploitative of consumers. The current average interest rate on credit cards, 21.47%, although some suggest it could be even higher. This is a notion, the capping at 10%, that even President Trump supported on the campaign trail.
While working Americans catch up, we're going to put a temporary cap on credit card interest rates at 10%.
Credit card companies say the 10% cap would be, quote, unworkable. They say it would actually harm the consumers that the policymakers are trying to help by limiting the types of credit that tens of millions depend on.
Now, if this does take place, obviously these financial institutions, banks, credit unions, they're going to lose money. So that means that they're going to lose money, but they still want to make new money. They're just going to make it harder to actually borrow money, which means you need to more than likely have a higher credit score or a stronger credit profile in general to get approved. The next major change is going to be number 4. The Capital One and Discover Card merger. In February 2024, Capital One said, listen, we're going to acquire Discover Card, okay? But as soon as they said that, a lot of people start pushing back.
Capital One is moving to buy Discover, which will really be a massive shakeup in the credit and banking world.
Yeah, DC News Now's consumer reporter and weekend anchor Ben Dennis is breaking down what you need to know if you're a customer.
Two finance experts tell me that if you have an account with Capital One or with Discover, you're likely not going to see any immediate changes. Meantime, that deal still has to pass a smell test by the feds.
Capital One moving to make a major purchase of their own, buying Discover.
You're not going to see any changes in the near future.
Merger and acquisition should come up with potential benefits to everyone.
Two financial analysts tell DC News Now that time is needed for federal regulators to review this deal, making sure Capital One doesn't become a monopoly. Shareholders benefit and customers too.
I think the big if is, does this pass regulatory muster?
And for possible changes for Discover customers, could it include getting rid of the company name on cards?
Absolutely. And this actually may come up with change in terms and condition rewards.
A lot of things may not change. I mean, after all, there's value to the business that they're acquiring.
It's unknown exactly how many jobs could be added to Capital One's portfolio, as they're based in McLean and have another campus outside of Richmond.
Merger and acquisition theoretically should bring value to the table. You're opening more branches online and physical in person.
We did ask Capital One if they do plan to add any more jobs in Virginia and adjust their payroll if this deal is approved.
Real quick, did you know that you can add your monthly subscription services like Netflix or Disney Plus, or even your cell phone bill to your credit report to improve your credit score? All you got to do is just scan this QR code or click the link in the description below to learn more. Now back to the video. It said that Democrats bashed Capital One and Discover merger proposal. A group of Congress members told federal regulators to consider Capital One's regulatory infractions in reviewing its proposed acquisition. Now, in the last 10 to 15 years, Capital One, like every other financial institution, they haven't been flawless. For example, in 2012, the Consumer Financial Protection Bureau ordered Capital One to return $140 million to 2 million consumers after finding that Capital One's vendors pressured consumers to buy add-on products. Then in 2018, the OCC fined Capital One $100 million in 2018 after finding that the bank was not fully compliant with anti-money laundering laws. And then on January 14, 2025, the Consumer Financial Protection Bureau sued Capital One again for cheating consumers out of more than $2 billion in interest payments on savings accounts. So if you're paying attention, we're starting to see a pattern here. And by the way, the Trump administration is more than likely going to end up throwing out the Capital One lawsuit that just happened. Now, if you made it to the end, let me know in the comment section below. But here's number 5, taxation of stolen funds. Now, under the Tax Cuts and Jobs Act of 2017, the casualty and theft loss deduction was taken away. This means that victims of scams and frauds can no longer take this as a deduction if they've had money stolen from them.
Scam victims targeted first by criminals, then by the IRS. Channel 2 Action News Investigates told you at 5 o'clock about a Metro Atlanta man whose Vanguard retirement account was drained by crooks. Now all new at 6 o'clock, Channel 2 consumer investigator Justin Gray is back with new details on the massive tax bill that man's now facing.
Well, Wendy, the IRS views all that money stolen from a retirement account by scammers as income the victim earned. Now, you may be thinking there's got to be a deduction or provision someone can use in these cases. Well, there used to be. It was eliminated along with many other deductions back in 2017 by President Trump's Tax Cuts and Jobs Act.
Well, it was pretty much my life savings.
We're hiding his identity because even this Metro Atlanta man's closest family doesn't know that $280,000 was stolen by scammers from his Vanguard retirement and investment accounts. Someone posing as a federal agent was behind the scam.
It was like my heart sinking. I feel like I was in a deep pit.
But now the real federal government, the IRS, will likely be coming for even more money. All that money stolen from his retirement accounts, Uncle Sam looks at that as income.
I'm looking at possibly $60,000 on top of my $280,000 that's gone. And I'm also looking at possibility of my Medicare Part B jumping up because of this phantom income.
For decades, there was something called the casualty and theft loss deduction. Christina Weiss runs the low-income tax clinic at Michigan State University School of Law.
Before, with the theft loss deduction, they would just list it as a deduction on their tax return and therefore wouldn't even owe the tax to start with.
But the Republican-led 2017 tax overhaul changed the deduction to only apply to losses related to a federally declared disaster. Meaning, according to this 2024 report from the Senate Agent Committee, quote, victims of fraud and scams can no longer deduct those losses and are often obligated to pay taxes on money that has been stolen.
You know, sometimes Congress has actions and they don't quite understand the repercussions. So now that they've seen them, hopefully this is something they will correct.
So for now, come tax day, it doesn't matter that Cooks ran off with his Atlanta man's life savings. As far as the IRS is concerned, he made some big withdrawals.
It appears on paper, yeah, that I did, but I never received it. That's the bad part. And I don't know how I can prove that.
So legally, without that theft loss deduction on the books, the IRS has to collect the tax debt. There are some programs to try to get debts reduced or get on a payment plan, but those can be very complicated to handle.
Now, this can also lead to unpaid tax bills or potential collections, which most definitely can show up on your credit report and affect your credit score. Now, no matter what you think about this or who you voted for, as an American citizen, you will be affected by either one of these changes for sure. And of course, we'll keep you posted along the way.